All over the news, we are bombarded by huge headlines of a potential US recession coming into the future. And now you might be confused as far as what is a recession and why is this recession inevitable and what are the implications behind this recession or potential recession that all these big analysts are talking about on TV, and you are very confused and you're trying to understand what that is. In this video, what we're going to do is I'm going to try to simplify that in very simple words so that you can understand exactly what are the implications behind the big recession words that you hear in the news all over the place. So now, the first thing first is let's define what recession is. Recession is typically defined as a period of economic distress. Now, you might be still confused. Economic distress, what is that? Basically, economic distress is a period where basically people have financial difficulties. People have difficulties paying rent and you have high unemployment. Basically, the rate of unemployment increasing with layoffs and a lot of those things going on into the economy. So that right there is a recession. Now, how is a recession defined? When we look at it on an economic standpoint, recession is usually defined as a certain period of basically a contraction of the GDP. Basically, what is GDP? GDP is defined as the gross domestic product. So then now, when you have two consecutive quarters of shrinking GDP, then you can say the economy of the country is in a recession. So then now, I understand that some of you may not understand what a GDP is exactly. So now let's define what exactly the GDP is. The GDP is defined as this. The GDP includes the consumption, or basically consumer spending. GDP includes government spending. GDP includes the net export. What is net export? Net export is basically how much the country is exporting minus how much the company is importing. And then the last thing that's part of the GDP are investment. So then now we see that there are four components that basically constitutes what a GDP of a country is. So then when we look at the United States, for example, 2/3 of the United States GDP is controlled by consumption. Guys, that is crazy. So then when we look at consumption, it's basically consumer spending. That means consumers in this country are basically dictating what the United States GDP is, because consumers control about 2/3 of the US GDP. So when I say consumers or consumer spending, what does that really entail? Groceries and services such as haircuts, right? That's basically what consumption is. So then, to be able to have a shrinking GDP, we have to have something in the GDP that is shrinking or something that is diminishing. So then, in this case, usually the biggest thing is consumer spending. Now, if you have consumer spending decreasing, and usually consumer spending can decrease because of inflation. And I'm sure you've also heard inflation a lot in the news lately, which we will also touch base on inflation, and we will also explain exactly how inflation does affect all of these that is going on right now. So basically, if the consumer spending is being affected by inflation, which we're seeing it in the prices of goods and services. For example, when we look at fuel prices are up 107%, exactly 106.7%. And then when we look at the price of food is up 10.1%. So then when you have inflation, basically rising prices in products and services, what's happening is consumers find themselves in a dilemma where things are getting so expensive that they cannot make ends meet. And when consumers have issues with making ends meet, that becomes a problem because consumers start spending less, because they try to save as much money as possible so they could be able to make ends meet, and they only spend on necessary things. And that right there makes it that the consumption in the GDP goes down. And since the US GDP is 2/3 consumption, and that right there trickles down into the economy or the GDP of the country, and basically that's how you end up into a recession. And if that happens 2 consecutive quarters, and basically that's pretty much a period of 6 months, then we can say that we are into a recession. So as I was talking about recession and talking about inflation, has inflation came up. Now, what is inflation? Basically, inflation is a rise in prices. Just make it very simple, is a rise in price. Something that was worth $10 yesterday, now you have to pay $12 for the same article that you paid $10 yesterday. Now, you might be wondering what causes inflation. And there are many things that can cause inflation. But 2 things that I can for sure tell you today that causes inflation. One is the cost of production, an increase in cost of production, and 2 is an increase in the money supply. And just wait and I will explain exactly what I mean by this. So when you have an increase in the cost of production, basically let's say that you have an increase in the production of fuel or production of gasoline. What happens is, if the production of gasoline gets more expensive for the producers, what the producer does is they end up raising the price of how much they are charging per gallon, which is why we're seeing in the US high prices of fuel. So then they charge more at the gas station on how much they are charging for that. And that basically, it's because their production costs are increasing, so they also increase the prices. So then, now that is one thing. The second thing is the money supply. And what I mean by money supply is, for example, when we go back to 2020, because of the pandemic that we had the Central Bank of the United States, or the Federal Reserve Bank, that basically came into the market. They decided to bring the interest rates close to zero, and I will explain interest rates soon. We will get into that. And also they started basically this whole idea that they called QE, or quantitative easing. And in simple terms, quantitative easing basically means printing money so that they could buy things such as mortgage-backed securities and bonds. And bonds, these are basically debts. What happens here is, as the government is printing money, and this money goes to the banks, and through the banks create loans. People come and borrow money from the banks. And what happens is, once people borrow money from the banks are the ones that are basically helping with increasing how much money is circulating into the economy. Let's say today we had $10 billion circulating into the economy. As the Federal Reserve prints more money, and they give that money to the banks, the Chase Bank, the Wells Fargo. Now, tomorrow Wells Fargo creates a loan of $10,000, or let's say creates a loan of $1 million. What happens is, now and people come and borrow $1 million. Now what happens is, now the money supply goes from $10 billion to 10 billion plus that $1 million. So the money supply increases. And once the money supply increases, and what happens is, if people are also spending that money into the economy, that ends up raising prices, because the purchasing power increases, while basically now the demand increases through purchasing power, but the supply is still the same. What happens is prices increases. So that is the second way of inflation, and how inflation basically affects prices. How can inflation be, countered? Because the problem with inflation is, the inflation makes the cost of living for people more expensive. So then what we're seeing in the markets right now is, we have really high inflation, and this is a product of basically the pandemic and all the policies that the government have made since we had the pandemic in 2020, from spending money and issues with things such as supply chain, because a lot of people are deciding not to go work in these in certain areas of the economy, like for example in for ports, where we have all these goods that have to be pretty much transported all over the world by sea. And basically, with the labor shortages and all these things, these are the things that are basically affecting the supply. And as they are affecting the supply, now we have to be able to combat inflation. Now, as you look at how we've had this inflation since 2020, because we've had the inflation growing for a while, the last numbers of inflation, or CPI, Consumer Price Index, that came out basically had inflation at about 8.6%. And this is basically showing that inflation is still rising. And we went from like 2% in 2020 to 8.6% in 2022. In only 2 years, we have had such a huge rise in inflation. So then what is happening is, because it's making the cost of living for the population or the average Joe very expensive, now the government wants to fight inflation by increasing interest rates. What is interest rates? Interest rates is basically can be seen as 2 things. One, the cost of borrowing. Let's say you borrow $1,000 at an interest rate of 6%. That means you're going to have to pay, and for a year, right? After a year, you have to pay that $1,000 back with an interest of $6. So you will end up paying $1,006. So that's the cost of borrowing. It's costing you $6 to borrow $1,000, 6%. Or inflation can also be seen as the gain in saving. Let's say you're saving $1,000 and you're receiving 6% in interest rate. That means at the end of the year, you're going to receive $6. Cost of borrowing or gain in savings or investment. So then what happens here is there is this idea of this economist called, I believe, Fisher. He's the one that came up with a formula, and the formula basically shows the real interest rate is equal to the nominal interest rate minus the inflation. So as I was saying earlier, to be able to basically counter inflation, we need to increase interest rates, because if we increase interest rate is going to try to fight inflation. So it brings the real rate, it either keeps the real rate constant if interest rates are increasing at the same rate as the inflation, or having the nominal rate increasing faster as inflation, and then we're going to keep the real rate constant. And what do I mean by nominal rates? For example, when you open a savings account and they tell you that you have a 1% interest rate, that 1% interest rate is a nominal rate. It's really not the real rate. And you have to take into account inflation to find the real rate. So let's say if you have nominal rate or interest rate of 1%, but then inflation is 2%. Or in this case, let's just be realistic with what is going on right now. You have a nominal rate of 1% with inflation at 8.6%. Now that means your real rate is negative 7.6%. What does that mean? That means you are losing your purchasing power at a rate or a speed of 7.6%. That means if you had $1,000 today, a year from now, you basically have $1,000 minus $7.6. That's how much you have. So you are losing your purchasing power because your money is being devalued. So in the future, the same item that you were able to afford today for $1,000, in the future, you won't be able to afford that. Right? That's basically what this means. So then in this case, what we're seeing with the Federal Reserve is the Federal Reserve, since last year, they were saying that they were going to start tapering. What is tapering? Tapering basically means that they were going to start raising interest rates and cutting on how much money they were pumping, how much money they were printing and pumping it into the system. So then they started increasing, 50 basis, 25 basis point, 50 basis point, and then the last numbers, this was this week, the Federal Reserve increased the interest rate by a 75 basis point, which basically means the interest rates went up by 0.75%. So now the interest rate is basically playing within a region of like 1.5 to 1.75%. That's where we are. So then increasing the interest rate is basically a way to try to combat inflation so we can bring inflation down. But that's not really exactly what we're seeing, because the Fed has been increasing interest rates since, pretty much early of this year, and we still haven't seen a decrease in inflation. But then why are we seeing already all these big headlines of a US recession, and also we're seeing the pain in the stock market that we're seeing? Is because an increase in interest rates makes it more expensive to borrow money for the average Joe, and also an increase in interest rates makes it basically makes it expensive for the average Joe in terms of, like, for example, credit cards. credit cards interest will increase because interest rates are increasing. And so now consumers will be like, well, I don't want to use credit cards anymore because if I don't pay, I'm going to have to pay higher interest on that money. And the other thing too is also it makes the cost of borrowing more expensive for companies. And that's a problem because if the cost of borrowing for companies increases, it basically eats into the company's profit. And hitting into the company's profits becomes a problem because now the companies start making less money, and what happens is these companies start cutting spending. And one of the primary ways of cutting on spending is laying off people, which is why we've seen the likes of companies such as Meta, ex-Facebook, Intel, Uber, some of the big techs pretty much implementing hiring freeze because they don't want to be spending more money by bringing in more people. Because if they hire more people, that means they're going to be spending more money. So if they stop hiring, now they're going to keep their spending at whatever it is at. Or we've seen, for example, Elon Musk coming out and hinting at Tesla slashing about 10% of their salaried employee. Those are layoff. That's how you basically decrease your spending. And that right there is a problem because if companies start cutting in their spending by laying off people or not hiring people, that becomes a problem because if a person gets laid off, that person is not making an income anymore. And if that person is not making an income anymore, that person is now susceptible to financial difficulties because that person now also is not going to be spending into the economy. And if that person doesn't spend into the economy, consumption goes down, the GDP goes down, we fall into a recession. So this is the reason why we're seeing all these big headlines as recession. This is the reason, the big, really, I would say, kind of, simplified answer of why we're seeing that. And so now that you understand what a recession is and what can cause recession and all these things, now the question is, how can you prepare for a recession? Guys, I think one of the things is to prepare for a recession, you really have to I think there are multiple ways of doing it. But I think the simplest way of doing it is you have to increase your cash position. And what I mean by increasing your cash position is, guys, it is time to save money. Cut your spending on any unnecessary stuff and start saving as much money as possible, because we never know. You may lose your job, you may not have an income, but if you have savings, you can be able to pretty much sustain a certain lifestyle until you find something, until maybe you start a business, until you find maybe another job, or you decide to go back to school. I don't know. But I think the best way of preparing for a recession is to start saving more money, especially now that interest rates are going up. That means if you save money, you're going to get a little bit more in interest on the money that you are saving. But having cash in a recession is good because it also helps you with, let's say you have certain opportunities coming up, basically maybe a tech stock that has been battered, literally battered. You can buy that and ride it for the next 10 years and make money. Or for example, you can get into real estate because recession can cause the price of real estate going down. You can buy a property, you can do many things, but for you to be able to do that, you have to have cash in hand. So guys, I'm not going to give you 3, 4, 5, 7, 18, 20 different formulas of how to prepare for a recession. The simplest thing to do is save, 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 save. That's all I had for you guys today. I hope that I provided you enough value in this video. And if that was the case, please allow me to ask you to hit the like button, subscribe, and turn on the notification bell. Thank you, and I will see y'all in my next video. Bye bye.